Hello, friends. A happy Republic Day, first of all. Uh, Welcome to this series. Don't get trapped in weak stocks. The idea here is to sensitize you that momentum can be used as a tool to identify stocks that are weak, to identify stocks that are strong, and to create a framework with which you can use this momentum scores to buy or sell stocks eventually. So this is a sort of a basic learning towards that cause, where your thought process, if it is completely right now in the mode of, either somebody will tell you what to buy or sell basis whatever analysis they're doing, or if you are watching earnings or some valuations, so on and so forth, or you know the bigger investors, what they're buying selling, all that is okay, but it does get you trapped a lot of times. And for not being trapped, I think the biggest lesson, at least I have learned and have implemented in my investing, is to not get trapped. Come what may, you should not be trapped. By trapping, what do I mean? Don't be trapped with extreme drawdowns. If your stocks have gone 60, 70, 80% down, there is near next to impossibility to get out from there. That capital that goes down 70, 80% takes decades to come back up. So you don't want to fall into that hole out of which getting out is difficult. You can fall into smaller, less deeper holes. That's okay. But you don't want to be stuck, in a deep one where getting out is difficult. So even more important than maybe how much returns we can generate on each of our investment, I think the more important aspect is how quickly we can get out if we are not going the right way. If the stock is not going my way, how quickly can I get out? I think that is the biggest key for your capital to remain safer, for your capital to remain adequate, so that you can take the next opportunity. You will be able to use that capital only if it is available. If the capital goes down 80%, and you're waiting for 5, 10 years, you can forget about making market returns in the next 20 years also. So the first and foremost rule of this game is to eliminate the negative parts, the extreme trappings of the market. It's just like you want to run 5 kilometers, but you don't want to fall. You may be slow, that's okay, but you don't want to fall flat on your face and not you complete that run. That is the whole idea that I, at least I have in my mind when I look at the markets, that I need to be continuously compounding. I don't care if some of my stocks don't work. I'm happy even if 50% of my picks don't work, but the next rest 50% should be doing well. That is the mind frame that one should have. So anyhow, let's get into this. So staying away from weak stocks, knowing when to exit a stock, sticking to the strength at all times. This is the basic thesis of momentum, and that you should not be going through a lot of regret, because regret, it has its own psychological cycle, which which downgrades your confidence. Every time you make a trade, there is a regret. Why didn't I buy? Why didn't I sell this? Why didn't I buy more? So if you go through that cycle, your self confidence will go down. You may incur huge losses. You may hold unperforming countries, underperforming stocks for long periods of time. And then, of course, opportunity cost is there, which has been lost. So we'll discuss three charts uh, with low momentum scores at present. We've taken three categories: large cap, mid cap, and small cap, basis the current large cap, mid cap, and small cap 250 indices, and compare them with stocks with the highest momentum scores in that category. Right. So how to read the momentum score is basically, it's a, let's say, a ranking of uh, large cap stocks 1 to 100. So we've ranked them 1 to 100 basis the weakest to the strongest. So momentum score of 100 is the strongest within that pack. Momentum score is the weakest within that pack. The first stock is Tata Motors. It is at a momentum score of 4, and it is down from 52 weeks high at about 38%. This stock should have been exited a while ago, right? So this is the first large cap weak stock that is there in our uh, score. The next weak stock is IRFC. This is also at a momentum score of 6. This is also down from 52-week high at 38. The third one is Indian Oil, and this is at 7. This is down from 52 weeks high at 32%. So this may have been a great stock here, but of late this has really lost its momentum, and some attempts were made here. Maybe it would have popped up in your portfolio as well, but then it has been moved out. So these three stocks are the weakest right now in the momentum scores. In the large cap space, if I see the weakest stocks, the bottom 10 stocks are at uh, momentum score of 1. So Adani Green is the weakest stock. Its last 1 year return is 39, 6 months return is 46% negative. IndusInd Bank, Adani and Sol, ATGL. So you can see a lot of Adani stocks are there in the large cap space. You have Asian Paints, a very big name here to be amongst the weakest stocks, almost 25% down for last 1 year. Tata Motors is there. Uh, Adani Enterprise is down 20%, IRFC is down 19%, IOC and DMart, although not so much down over 1 year returns, but on a momentum score within the top 100 stocks, this is one of the weakest stocks. The top stocks in this category, if you were to see 99 to 85 score, are actually 26 to 58% on 6 month to 1 year return. Then is another stock is 70% up, although on 6 month basis it is not up much. 6 months market has been flat, so 1 year basis it is still up, but 6 months basis is not up. Uh, stock number 3, 72%, 67, 59, 48, so on and so forth. So you can see that versus the previous table, where you had a string of large negative numbers, you have a string of large positive numbers. So the idea should be to have these stocks in your portfolio and gradually shuffling. I'm not saying today was a decision point for this to happen. This would have happened on a regular basis, where gradually these stocks would have moved out and these stocks would have moved in to your portfolio. Let's now look at mid caps stocks. So one of the mid cap stocks with very poor momentum score is Vodafone Idea. So mid caps are the you can take the mid cap 150 index, so 101 to 250th ranking. Here the momentum score is even less than 1, although this has moved up from the bottom. About 50% it has moved from the bottom, but from the 52-week high, it is down considerably. This number is wrong. This is 50% probably from the bottom, but from the top 52-week high, we are down more than about 50% down as well, 19 rupees to about 9.5 rupees. But from its all-time high, it is down maybe like 90%. So this is one weak stock that we have here. You also have, and also to add here, when you look at momentum score, when you look at slow momentum strategies, you're not really looking at very short-term phenomena, like what's happening in 1 week or 3 weeks, or maybe even couple of months. This is a long-term, where is the stock standing in terms of its trend. Astral, it was doing very well till July, and then it has just collapsed from 2400 to 1400, so down 40% from the top. This is another stock with poor momentum score. And ZFCom control system, this stock is also there in the mid cap space, down from 18,000 to 10,000. It's dropped really fast post November. This also is down 44%. These stocks ideally should not be there in your portfolio from a momentum perspective. So this is the list of mid caps that have the weakest momentum scores. MRF is part of this, so 21% down here. Bank of India is down 26%. NIACL, I remember NIACL was doing well. SJVN was doing well at one point. We had these stocks in our portfolios as well, but long time back they were exited. AWL minus 28%. ZFC, we've already discussed, 41%. Astral minus 20, Yes Bank minus 26%, even on 1 year returns. Tata Tech, this was really hyped up for this entire last 1 year, minus 32%, and Idea is at minus 37% for 1 year. So pretty poor performance on all these stocks. These are all weak stocks. On the other hand, within the same space, And you can guess a guessing game if you like. There's one stock which is up 176% in mid caps. There's another one at 133, 161, 85, 101. So many stocks are there which have done really well within the mid cap space. And hence, if you were to, continuously monitor the mid cap space on a weekly or a monthly basis, you will be able to identify which stocks are doing well, which stocks are not doing well. And that is the whole idea of momentum investing in the small cap space. Now, small caps, we have taken small cap 250 as the basis for our selection. So 250 stocks. Honasa Consumer. Uh, Frankly, I never liked this stock. This was a very hyped up stock, but that is my personal opinion. And um, it has been falling from 500 rupees to almost 243. 55% is the fall, especially this crazy fall that you can see here. And even otherwise, I mean, you just see, where the stock is on a 50, 200-day moving average. You'll figure out where the stock is going. It has a momentum score of 1. Network 18, this was, I remember, riding this wave and then getting out somewhere here. Uh, this also has collapsed from 130 down to 52 rupees, 62% down, 1.2 on the momentum score. If you are stuck in stocks like these, they will sap away your capital and never come back. Uh, okay, let me not say never, but it's difficult for these stocks to really come back and restore your capital in any quick way. Uh, as a market rule, never say never, because anything can happen in the market. Rajesh Expo. This is, I remember a couple of years back, this used to be a star performer in our portfolios. 46% down from 52-week high. Momentum score is at 2.4, and it's gone from 500 rupees to 197. Extreme, capital loss is happening in so many places. It's amazing. So the worst scenario in small cap index, Honasa is 49% down, Network is 57% down, Rajesh Expo 45, SW Solar. This used to be a blue-eyed renewable energy stock just till very recently. Tenla, I remember, I think this was 3 or 4 years back. This was like a 7-8 bagger for us. It has collapsed since then, minus 43%. Spark, minus 55%. RBL Bank was supposed to become the next HDFC Bank. It is down 40%. Ease My Trip, I don't know why the promoters keep selling their stake, minus 39%. Chennai Petro, minus 27%. Aarti Industries also at one point was doing well, minus 32. So most stocks will do well at some point in their journey. You have to identify that portion where they're doing well. That's about it. It's like, there are 1,500 buses standing on the bus stand, and some will start off, board them. Then others will start off, board those. Then others will start off, board those. We need not get stuck with, names just because, we really like those names. Within the same space where we saw these 50-60% types of losses, you have stocks which have done 176%, 170%, 156%. I mean, these are amazing numbers for those stocks. Even if you were to get some portion of these returns, I'm not saying anybody will be able to generate this list in their portfolio with these returns. That is not the idea. The idea is, if you are able to eliminate some of these stocks from your portfolio, reduce some of this loss from your portfolio, have some of these stocks in your portfolio, add some of these returns to your portfolio, that is the sort of the thesis that I'm building on, will give you that counterbalance. Because if you're losing stocks, continue to lose capital, you also need to generate capital from somewhere. And more often than not, stocks that will lose, at least in the same avatar, will not come back. They will go through some long period of consolidation, some restructuring, some merger, some demerger. Something will happen, some restructuring happens, and then they will, management change may happen, some industry change may happen. Then at one blue in one 5 years later, 10 years later, that stock may come up back up again. So, or may not do that at all. So when you can't wait for that, basically. So this is basically like it's like an automatic churn that is happening. That as I mentioned, buses have started. The buses that are slowing down, just keep getting off them. Buses that are continuing to move, get onto them and keep churning that. That is the only sort of way to keep with the strength in the market. So holding on to weak stocks erodes your capital. It erodes you. It prevents you from better opportunities. Okay, one question that people are asking is why we are not showing top momentum stocks. So top momentum stocks can become recommendatory. So there are some license constraints that are there, but the objective behind this series is also to help you develop a mindset to stay alert, to identify these yourself, to exit weakness in your portfolio. And obviously, even if I were to show you which are those 10 stocks, some people will start to deploy money basis this presentation, and I don't want that to happen, because once you will deploy, how will you come to know when to exit? So it must be handled by some professional. Find somebody to follow, find your own methods, whichever way you want to do that. So you basically want to remain invested in the strongest stocks at all times. That is the whole purpose, that if we have large cap 100 list, out of that, if my strongest stocks are top 20, my weakest stocks are bottom 80, I want to be in the top 20. If that changes next month, I want to change my proposal. The how you calculate the strongest stocks can be your own methods. There, of course, any method can work, for that matter. Just like in regular identification of what stock to buy, there are 1,000 ways. Somebody looking at EPS, somebody looking at growth in margins, somebody looking at market share. Similarly, in momentum investing, also there are 1,000 ways you can do it. So there is no one way. Uh, so you can, however, consider momentum investing for finding your way to this path. The momentum way obviously automatically identifies and rides high momentum stock. A lot of folks correlate momentum to short-term trading. Uh, so this myth needs to be broken. Our average hold, for instance, is about 6 months on a stock. So this is not short-term trading. Yes, it is not long-term investing. Although in several uh, years we've had stocks, 30% of stocks go long term also. So from that perspective, you need to have this thought process that in couple of quarters you are able to identify which sectors are starting off, which sectors are cooling off, and that really is the reason why the faster change of the stocks in your portfolio is required. uh, of course, momentum also quickly discards stocks that lose momentum to make way for relatively strong stocks. So how healthy is your portfolio is something that you would want to measure. So what percentage of your stocks are in strong momentum? What percentage of your stocks are in weak momentum? Is your portfolio overly concentrated? Is your portfolio well diversified? You can find this out. You can go to our health checkup momentum report. You can get all the answers. Go to weekendinvesting.com or use this QR code. And two critical parameters will be uh, sent to you on a PDF once you put in your portfolio details. We are not storing any portfolio details for anybody, so there is no privacy issue in that. You will put in your details and the system will throw you a report back on your email, and you can study that report. This is the disclaimer. Please read this disclaimer and let us know how you like this content, and I'll see you next week. Thanks. Bye.